Thank you everyone for joining us on this Monday morning or midday. We will be talking about greenwashing today, specifically about the different types of greenwashing. But before we kick in, let me just quickly introduce myself and Planet Tracker. My name is Nicole. I'm the head of engagement here at Planet Tracker. Planet Tracker is a nonprofit sustainable finance think tank working on aligning financial markets with a sustainable future. We produce research on nature-related risks and opportunities and advocate for financial markets to integrate these into their analysis and ultimately their decision-making. Everything that we do as an NGO is for the common good, so you can find all of our research available on our website or on most common financial data platforms. And with that being said, today we will spend the next 30 or so minutes to speak about greenwashing. We deem it important to talk about it because greenwashing activities are becoming increasingly sophisticated. They can range from seemingly harmless strategies, which, for instance, market a product inaccurately, making it look a little bit more green, to practices which emphasize a singular green activity to intentionally distract broader damaging environmental practices. And because there's such a variety of greenwashing activities, they can sometimes be quite difficult to spot. So we want to use the session to make you aware of these greenwashing strategies and help you recognize them. But before we dive into it, we need a definition of what we mean when we speak about greenwashing. Client Earth, the environmental law NGO, provides quite a helpful definition there. They define greenwashing as the use of advertising and public messaging to appear more climate friendly and environmentally sustainable than a company really is. They go on to say that it is a technique which is used by certain companies to distract consumers from the fact that their business model and activities actually do a lot of environmental harm and damage. So greenwashing is about changing our perception, really, changing our perception of the company, their products or projects, making them look green when oftentimes they're actually the opposite. What is important to note is that whilst greenwashing is always misleading, it is not always illegal. Regulators have started to tackle the issue. There's still a number of regulatory loopholes there which can be used. It's something that we'll look at later as well. So the question that we can now ask is, why would companies engage in greenwashing activities at all? Sometimes it is possible it may occur as a result of plain corporate ignorance. But oftentimes, companies are making deliberate decisions to market their products and activities as sustainable to attract consumers, which leads to increased sales volumes and then enabling them to raise their prices. There's also an increasing number of employees which are attracted to work for companies with strong sustainability credentials. So being perceived as sustainable can help with attracting either new employees, but also can help with employee retention. Another reason is that companies can attract a valuation premium relative to their peers as investment into sustainable and ESG funds is increasing. This in turn can lower the cost of capital as their equity attracts a higher price, and they therefore have to issue fewer shares to raise funds. And the same can also be true of green debt, where investors have been prepared to accept a lower yield in return for sustainability and ESG targets. So, looking at the reasons as to why a company might engage in greenwashing activities, it's because the claims carry quite a lot of upside, unless the claims are shown to be false. And it is important to show that these claims are false, as it does hinder the development of a green economy. So, with that being said, a few months ago, we have published a report called the Greenwashing Hydra, which identifies 6 different types of greenwashing. The 6 different types that we have identified are greencrowding, greenlighting, greenshifting, greenlabelling, greenrinsing, and greenhushing. And what we'll do next is we'll go through each of these different types of greenwashing in the next slides and discuss them in detail and provide some examples so you're able to spot them as well. The first type of greenwashing that we have identified is greencrowding. So greencrowding is built on the belief that you can hide in a crowd to avoid discovery, and it really relies on safety in numbers. What often happens is that a group will move at the speed of the slowest. It is a strategy that is very clever because investors and also the media are naturally attracted to large numbers associated with groups. So this can be either the number of corporate signatories or the implied cumulative investments. I'm sure you've all seen groups where it states that they have X signatories with X amounts of AUM, for instance. But large groups are not always ambitious. Agreeing on the lowest common denominator and providing companies with the ability to really hide within the crowd. What is important is to review targets and progress towards these goals and make sure that they are ambitious in the first place and that they are being achieved. An example for Greencrowding is the organization, the Alliance to End Plastic Waste. The Alliance to End Plastic Waste is a group made up of over 65 companies from the oil and gas sector, the chemical sector, plastic container and packaging companies, as well as downstream consumer companies. They are well-known companies such as Shell, ExxonMobil, BASF, Dow, Berry, PepsiCo, and Procter & Gamble, and they're all part of the Alliance to End Plastic Waste. And the goal of the Alliance to End Plastic Waste is to end plastic waste in the environment and protect the planet, which the organization describes as an ambitious goal. And we would agree it is a really ambitious goal. But looking at the organization and their goals more closely, it becomes clear that it is not necessarily what it seems. For one, the group is closely linked to the American Chemistry Council, a large and powerful American lobby organization, which, for instance, has lobbied against the establishment of a framework for the Global Plastic Pollution Treaty. A large proportion of the companies who are members of the organization of the Alliance to End Plastic Waste are also part of the lobby group and have not supported the plastic treaty. Secondly, the targets that the organization sets are also not necessarily ambitious. Within the first 3 years, the Alliance recycled less than 0.0004% of global plastic generated. And in addition, the top 10 producers of single-use plastic that are members of the Alliance to End Plastic Waste did not remove or recycle 99.99% of their own plastic waste. And the organization has also not provided transparent, measurable, and audited information thus far. After pressure from groups like ours and others, this is due to change, though. So this is really a good example of where a group is formed with seemingly ambitious goals, but under closer examination has achieved very little, which shows how important it is to scrutinize some of these larger groups. This leads us to the second form of greenwashing, which is greenlighting. Greenlighting occurs when a company or company communications, including the advertisements, highlight a particular green feature of its operation or products in order to draw attention away from environmentally damaging activities being conducted elsewhere. A very good example here is Total and their rebranding to Total Energies in 2021. When Total promoted their name change on Twitter, they used the hashtag more energies, less emissions, and referencing how it was adapting to meet the climate challenge. However, Total Energies has plans to maintain oil production and increase gas production. This act of greenlighting led to a lawsuit being filed against the company for breaching the ban on misleading practices under the European Unfair Consumer Practices Directive. And the lawsuit states that Total Energies, in fact, plans to produce more fossil fuels between now and 2050, making their net zero target unachievable. So this is really a prime example of green lighting. The next form of greenwashing that we have highlighted in our report is greenshifting. Greenshifting is when a company implies that the consumer is at fault and shifts the blame onto them, effectively trying to make the consumer responsible. There are two examples here that I would like to share with you. One is from Shell and the other one is from ExxonMobil. In November 2020, Shell asked people what they were prepared to do to help reduce the world's carbon emissions. Just as a reminder, Shell is one of the largest oil and gas companies in the world. It's responsible for a large share of emissions, and a company which many claim has been aware of the damage emissions were doing to the planet for decades. The audacity to ask consumers what they are doing to reduce emissions whilst being at the heart of the problem is something that has been called out by many, such as US Congresswoman Alexandra Ocasio-Cortez, for instance. Another example is by ExxonMobil. In May 2021, Harvard researchers published a study of ExxonMobil's use of language. What they found is that there's quite a discrepancy between how ExxonMobil communicates internally and in academic papers versus how they communicate with the public. They found that in company communication and academic papers, ExxonMobil often used phrases like fossil fuel and recognized the major role that products play in global warming. But the company's public communications focused on consumers, demand, energy efficiency, which implies they're publicly pointing the finger onto the consumers. The strategy is probably one of the easier ones to identify, and we do anticipate that advertising agencies who work on behalf of corporates will be more cautious going forward about adopting these strategies, as a lot of companies have been called out on them. The next form of greenwashing we want to look at is green labeling. Green labeling is a practice where marketers call something green or sustainable, but a closer examination reveals that the words are misleading. It is one of the forms of greenwashing, which is probably the most pervasive. There's currently a class action against KLM Royal Dutch Airlines, for instance, for allegedly misleading claims by encouraging customers to offset and reduce their environmental harm of flying by purchasing carbon credits through their CO2 zero program. The lawsuit claims that there's no credible evidence that purchasing offsets nets out the environmental effects of flying. But sometimes these claims might also be only partially misleading, and this is where it's becoming a little bit difficult and tricky. In 2019, for instance, SC Johnson's Windex Vinegar Ocean Plastic bottle claimed to be the world's first window cleaner bottle made from 100% ocean plastic. But when looking at the footnote, they expanded the definition to ocean-bound plastic. Now, ocean-bound plastic does not necessarily need to come out of the ocean, but is plastic which is collected within a 30-mile radius of an ocean or waterway, which lead to an ocean. So the claim is not necessarily completely false, but it's also not entirely true. Green labeling is an issue that the European Commission has been focusing on. The Commission acknowledges that it is difficult for consumers, for companies, and other market actors to make sense of the many environmental labels and initiatives on the environmental performance of products and companies. The Commission has assessed that there are almost 200 environmental labels active just in the EU and more than 450 worldwide. Out of those, 80 are widely used just for carbon emissions only. So we can clearly see that this is a very confusing space, especially for consumers. The terms are often also ill-defined, but some of those that are widely used can be seen on the screen here. So we see words such as bio, from nature, natural, green, or eco-friendly, for instance. The European Commission is by no means the only organization seeking to define these terms. The US Federal Trade Commission, for instance, is also looking at the accuracy of various environmental claims at the moment. This gets us to the fifth form of greenwashing, which is greenrinsing. Now, greenrinsing occurs when a company regularly changes its ESG targets before they are achieved. In our own research, we have found a couple of examples where companies have changed their targets quite frequently. In our report, Soda Pressing, we examined both Coca-Cola and PepsiCo and have found that the companies adjusted their recycling targets before their target date. What they do is they have pushed the target date out while at the same time increasing their previous target. Over the past 5 years, PepsiCo has changed its recycling targets 3 times, whilst Coca-Cola has done so twice. And in addition to that, both companies have identified a number of risks which might not let them meet their targets. Coca-Cola has identified 47 reasons why they might not meet the targets, whereas PepsiCo has identified 13. What is interesting is when you look at these risks, they're quite broad and allow companies to easily find a reason why they might not have met their targets. Greenrinsing really shows that greenwashing has become increasingly sophisticated, in our opinion. The origin for greenrinsing can be found in companies which set very ambitious targets, but then fail to achieve them, and their rhetoric then failing to match their sustainability outcomes. Over the past years, we have witnessed an explosion of sustainability metrics, of claims, of targets, but many are not substantiated or look unlikely to be achieved. Net Zero Tracker, for instance, has found that of the top 2,000 publicly traded companies by revenue, only 702 have a net zero target. And out of these 702 companies, only 64% meet minimum reporting standards. So clearly that is an issue. We particularly think this is a case for investors to engage with their portfolio companies and push for credible targets and disclosures. And that brings us on to a related form of greenwashing, greenhushing. Greenhushing occurs when corporate management teams underreport or hide their sustainability credentials in order to avoid investor scrutiny. South Pole conducted a survey with 1,200 global sustainability executives and found that nearly a quarter did not publicize their climate achievements and milestones beyond the bare minimum. In recent months, we have seen a number of large asset management firms, including HSBC, Amundi, and BlackRock, downgrade a number of Article 9 funds to Article 8 classifications. Article 9 funds are those that specifically have sustainable investments as their objective. They are often referred to as dark green funds. And then the Article 8 funds are funds which promote environmental or social characteristics as well as good governance, but do not have them as an overarching objective. They're also known as light green funds. And the downgrading is most likely a response to the Sustainable Finance Disclosure Directive, called SFDR, which will come into place in the beginning of 2023 in the EU. The firms claim that this is merely a reaction to overly strict regulation, but an alternative interpretation is that these downgrades have been made to avoid the scrutiny of Article 9 standards. Some people might be surprised we include greenhushing as a form of greenwashing, but we do believe that it's not as innocent as it may seem. Quite the opposite, actually. It shows how sophisticated greenwashing techniques have become. Companies might deliberately use these techniques to gain a green valuation uplift without subjecting themselves to proper investor scrutiny by suggesting that their company's sustainability performance is stronger than it actually is. So these were the different types of greenwashing. And looking at them, regulators are now starting to address the issue by identifying the problem, gathering information, and proposing new regulations to enable informed choices. Regulators in the EU, in the UK, and the US have been at the forefront on this. In the EU, the foundations have been laid with the EU's Unfair Commercial Practices Directive, the EU Taxonomy, and the proposal for a directive on empowering consumers for the green transition. Also, just a few days ago, the European Supervisory Authority put forward a common high-level understanding of greenwashing applicable to market participants across their respective remits, which is banking, insurance and pensions, and financial markets. In the UK, the foundation has been laid by the Task Force on Climate-Related Financial Disclosures reporting mandate and the Green Claims Code. And in the US, the Securities and Exchange Commission, the SEC, has been particularly focused on greenwashing issues for both funds and corporates. In 2021, the SEC established a climate and ESG task force to develop initiatives to proactively identify ESG-related misconduct, and in 2022 successfully enforced it on two financial institutions. One was BNY Mellon and the other one was Goldman Sachs Asset Management, because both failed to follow correct ESG procedures. And they also included two mining companies in that, Vale and Compass Minerals, which manipulated dam safety audits and failed to adequately assess the financial risk of mercury contamination. And for non-financial regulation in the US, the Federal Trade Commission continues to prosecute cases of greenwashing. But there's also other regions that are making moves. Australia, for instance, has recently enforced its laws on greenwashing after the securities regulator, the Australian Securities and Investments Commission, issued an information sheet on how to avoid greenwashing when offering or promoting sustainability-related products. And they go on to state why greenwashing is unacceptable, stating that it distorts relevant information that a current or prospective investor might require in order to make informed investment decisions. In 2022, the ASIC issued 3 infringement notices on investment manager Vanguard Investments Australia in further action against alleged greenwashing. So clearly they're also enforcing it. And in Singapore, the Monetary Authority for Singapore, MAS, has progressively integrated environmental risks into its supervisory framework and processes at the individual firm and system-wide level. In Japan, the Financial Services Agency has recently called for responses to its supervisory guidelines regarding ESG investment trusts, and other countries such as China and Malaysia have also started to address greenwashing. So clearly there is increased scrutiny, and regulators are shining a spotlight on misleading and increasingly sophisticated greenwashing. And it is something that we at Planet Tracker very much welcome. So this brings us to the end of our presentation. I wanted to highlight two more things. We are presenting on two further topics this week during EU Green Week. So if you want to join us on the interaction of traceability and sustainability in fashion, please do so on Wednesday. And on Thursday, we will be talking about how to prepare for biodiversity. We will send the link around where you can register, and we would look forward to having you there. We also got a couple of questions, which I will answer now. If we cannot answer your question because we run out of time, we will send across the answers. One of the questions we got was where you can find the research. So all of our research is available on our website on planettracker.org. You can register there and you will get all of our research, and you'll find the Greenwashing Hydra and other related papers there. Another question we got was on what the downside is of using greenwashing as a technique. I hope part of it was answered in the presentation, but clearly it is reputational risk, it is legal risk, and it is financial risks that are really driving this to be a risk. I see some more questions on, in your opinion, is the European Union a leader in tackling greenwashing? The European Union indeed has made quite some significant steps and has been ahead of some of the other regulators. However, as mentioned earlier, there is quite a lot of movement in this space, and we anticipate for that to continue. So we do think that other regions might be catching up with the European Union on that. If you have any further questions, please feel free to add them in the chat. Another thing to note is that we will send the presentation around, and you'll have access to it. Again, if you have any other questions, please feel free to reach out to myself or anyone else at the Planet Tracker team. We hope that you found this session useful, that it provided some insights onto the different forms of greenwashing, and that you're now going to be able to be more attuned to these types and be able to spot them. Thank you very much for your time, and we look forward to seeing you at one of our further presentations. Thank you.